Hello, everyone. I'm Jessica Barton, founder of Barton Realty, and I'm thrilled to welcome you to this important video where we'll be exploring the locked-in effect in the real estate market and how it's impacting sellers right here in Indiana. At Barton Realty, we understand that the current housing market conditions can be daunting, especially for those who are on the fence about selling their homes. The locked-in effect, caused by higher mortgage interest rates, has become a significant concern for homeowners across central Indiana. The truth is, many homeowners purchased their homes when interest rates were significantly lower. Now, with rates on the rise, these homeowners feel locked into their current mortgages, hesitant to sell, and potentially face higher borrowing costs. But here's the good news. Barton Realty is here to help you overcome the locked-in effect and navigate the current market challenges. Our expertise and personalized approach will guide you through the process, empowering you to make informed decisions. We believe at Barton Realty that education is the key. Throughout this video, we'll be sharing valuable insights and practical strategies to help you break free from the locked-in effect and take control of your real estate journey. Whether you're looking to downsize, upgrade, or explore other opportunities, we have the knowledge and resources to assist you. Our goal is to provide you with a clear understanding of the options available, enabling you to make confident choices that align with your goals. But we're not just here to help you overcome the locked-in effect. We want to be your trusted partner throughout your entire real estate journey. From buying and selling to investing or starting a career in real estate, Barton Realty is here to help you every step of the way. Before we dive into specifics, make sure to give this video a like and subscribe to our channel. By doing so, you'll gain access to more valuable content that can help you navigate the real estate landscape with confidence. And don't forget to download our mobile app through the link in the description below. It's a powerful tool that will keep you informed about all things real estate in your local area and allows you to connect with us through your favorite social media platforms. Now, let's break free from the locked-in effect together and unlock the possibilities that lie ahead. Are you ready? Let's get started. Let's get back to talking more about the locked-in effect in the real estate market. Let's be honest here, being locked in doesn't always have a negative connotation. In fact, there are some situations where it can bring certain benefits. Think about it. Have you ever experienced being locked in a way that brought excitement and security? Like when you secure your seat on a thrilling roller coaster ride with the click of the harness locking in, or when you sign a long-term rental agreement for your dream home for an extended term where you know your rent won't go up in 12 months. And let's not forget those membership rates that grant you access to amazing services or facilities at discounted prices, but only if you lock in for a year membership instead of month to month. Consider the gym membership you committed to and actually made the most of. Being locked in to a year membership on autopay, you established a routine, stayed motivated, and achieved your health and fitness goals. However, there are some instances where being locked in can hold you back. It's like being stuck in a business partnership that no longer aligns with your vision, or being tied to an unhealthy relationship where you share a lease together. Let's take a look at the same examples, but the flip side of being locked in. Think of being harnessed in that same roller coaster seat and realizing that the corn dog you had before you got in the line for the ride is coming back to haunt you. And now you're locked into the ride, no way out. Or that dream home you signed a 24-month lease on becomes a nightmare when you discover the dogs next door howling all night and barking all day. What about that great gym membership that has a fee being withdrawn from your account each month, even after you break your leg and can't do the exercises you love? And sure, that year subscription sounded great when you were first using the software, but what about when the new AI is developed that allows you to do the same thing easier and free, but here you are locked into another 8 months of subscription fees? You see how being locked in can be an amazing thing or a terrible nightmare. The same thing can be said for the locked in effect taking hold of sellers right now in the real estate market. Sure, they may have an excellent mortgage rate from when they bought a home 6 years ago, but what if that home is way too small now that they've added a few new lives to their family and each day they dread coming home to a house that's just too small? To overcome the limitations of being locked in, a mindset shift is crucial. It's about recognizing when being confined or connected is holding you back and having the courage to break free from those restraints. It's time to let go of the fear and hesitation that come with feeling locked in. It's time to embrace change, take control, and create a life of freedom and abundance. So don't let the feeling of being locked in hold you back any longer. Join us as we dive into practical strategies and insights to help you overcome the locked in effect and embrace a life of boundless opportunities. Let's explore how the concept of being locked in directly affects the current state of the housing market. As you may know, the housing market is influenced by various factors, and one significant aspect is mortgage interest rates. These rates play a crucial role in determining affordability of homes for buyers. Over the years, we have witnessed fluctuations in mortgage interest rates, which can have a profound impact on homeowners and potential buyers alike. Interest rates are low, like they have been in recent years. It creates an opportunity for buyers to secure favorable mortgage terms and lower monthly payments. This situation often encourages buyers to enter the housing market, seeking to take advantage of these historically low rates and realizing their dreams of home ownership. However, once buyers secure a mortgage at a specific interest rate, they become locked in. They are bound by the terms of their loan, including the fixed interest rate and length of the mortgage term. Now, here's where the locked in effect comes into play. As time goes on, interest rates may start to rise. This can create a dilemma for homeowners who are considering selling their property. Higher interest rates mean that potential buyers in the market will face increased borrowing costs. It can make home ownership less affordable for some, which can impact the demand of properties. Consequently, homeowners who are locked in at lower interest rates may hesitate to sell their homes. They may be concerned about the possibility of not being able to find comparable mortgage rates for their next home purchase. This hesitation to sell can contribute to a lack of inventory in the market. When there is a limited supply, it can lead to increased competition among buyers and potentially drive up home prices. So being locked in at a lower interest rate can have a significant impact on the housing market dynamic, influencing both supply and demand factors. At Barton Realty, we understand the complexities of the locked in effect and its implications for homeowners and potential sellers. Our team is dedicated to providing guidance and solution to navigate these challenges. Now let's take a look together at some of the information from the current and past mortgage interest rate changes. Okay, so the first thing I want to do is show you how you can do a quick Google search to find out what the interest rates are. We're going to hop in here and I'm just going to put mortgage rates today, Indiana, and you'll see that it brings up this little tool from Google that we can use. So for the loan amount, let's go ahead and do a $300,000 home. Unfortunately, this tool does only give you an opportunity to go by 100,000 for the loan amount. So we'll go with that for now. Down payment wise, you can change this. You can go as high as 35%, but we're going to go with 5% just because that seems to be an attainable goal for first-time home buyers when they are thinking about getting a home. So we're in Indiana here for Barton Realty, so I'm just going to focus this on Indiana, but you can change it to whatever state you happen to be in. For the credit score, if you know your credit score or about where it is, you can go ahead and change this in here. I'm going to go ahead and choose 700 to 719 just because a quick Google search of what the average credit score of an American in 2023 came back with a 714. So I figure we'll just go with that average amount and put that in here. It'll tell you different loan types. So here you'll see this is a 30-year fixed and a 15-year fixed. I'm going to go ahead and add some loan types here. It'll allow you to do up to 5 at a time. So we have a lot of first-time homebuyers who choose to utilize the FHA program. So I'm going to go ahead and choose that one. And then we do work with veterans frequently. The VA loan is, of course, a 0 down loan with no PMI. So I'm going to go ahead and choose that one too. And then the 30-year USDA loan. The areas that we service are mostly Indianapolis and the surrounding counties, but those surrounding counties do still have some land that's eligible for USDA home loans. If you'd like more information on that, we'd love to talk to you about those as well, or you can check out our other videos. I'll link to a couple of them in the description, so you can just find out all that information on USDA loans and what's available. But let's go ahead and put those in and see these rates here. So 30-year fixed, and this is going to be as of June 1st, 2023. Even though today is June 2nd, this is going off of yesterday's rates. Rates do fluctuate slightly, and it can be every day that they're a little bit different. It's very important when you're thinking about buying a home to speak with a mortgage loan professional that you have done extensive research on. You've checked the reviews, you've talked to your real estate agent about who they would recommend, you've listened to different people's experiences, and you have a lender that you trust. You want to talk to them about this kind of stuff. But just a real quick breakdown here. You're going to see a 30-year fixed is at 7.34%, 15-year fixed is at 6.51%, 30-year fixed FHA is at 7.093%, 30-year fixed VA is at 7.305%, and a 30-year fixed USDA is at 7.212%. Speaking of taking a look at some of those long-term graphs, let's take a quick look over at the vision speech slides from the Keller Williams Family Reunion 2023 back in February. There's some really great information in these slides, and if you follow the channel over the last few months, you've seen us use a couple of these throughout some of the stuff. But if you're interested in seeing more of these graphs or learning more about what these numbers mean for you specifically, of course, reach out to us. We're happy to get them to you and answer any questions. But let's take a look at that graph really quick over here. So we're just going to come down to where it's talking about mortgage rates here. So you can see this graph that they've done for us here is sourced from Freddie Mac, but it is the numbers, the interest rates where they've been at since 1972. So if you look here, they do have the historical average is running right up here at 7.81%. You can see at the high point of interest rates back in the late 70s, early 80s, we were looking at about 16.63%. So when you look at that number versus the 7.093%, it doesn't sound so bad. But at the same time, when you look here at 2012 and you see rates, averaging 3.8%, that's almost half of what it's going for now. So, that can be pretty daunting. And again, you can see where the locked-in effect really kind of grabs hold of the market here when the rates start to come up. This is just 2022. So, we're going to see 2023 even higher come this time next year. So, just an interesting look at how it's gone. If you're like me, you like to look at the graphs and kind of see for yourself and visualize how the trends go versus just hearing or seeing the numbers. So I thought that this might help you out to take a look at that. And then again, you can see sort of where the monthly mortgage rates have gone since January of 2016. when they were at 3.87%. And then you'll see we got up in the fours, kind of hovered there for quite a while. And then it came back down, and then it really came back down to the 2.74%. If you locked into that rate, good on you. Very impressive. Good decision making. Although in reality, you probably did pay much more for the home than what you were expecting to because of the way the market was back then. But at that 2.74%, golden, chef's kiss, you did great. And then it started to rise up here, the 3.45%, okay, January 2022, that's iffy. But then you can see by the end of the year last year, we were above 6%. So we really saw the locked-in effect sort of start to strangle the inventory that was coming out on the market around that time, and it has only gotten worse. There's a lot of talk about, what's going to happen in the economy over the next few months, and the reality is we don't have a crystal ball, but we're not expecting interest rates to fall back down into that 2% range again in the near future. So if you're considering selling your home this year and you're wondering how you can break free from that locked-in effect, there's actually a couple of ways. The first one I want to cover is something called an assumable mortgage. I thought it might be good just to take a look at this Investopedia article. They do a great job of breaking things down and making it really simple to understand. So an assumable mortgage is a type of financing arrangement whereby an outstanding mortgage and its terms are transferred from the current owner to a buyer. By assuming the previous owner's remaining debt, the buyer can avoid obtaining their own mortgage. Different types of loans can qualify as assumable mortgages, though there are some special considerations to keep in mind. So essentially what it's saying is that you could take over the mortgage that a current homeowner has on the home. So let's say they bought the home and they locked their mortgage in at that 2.74%. Well, wouldn't it be great if in a time where the market is showing 7.03%, you could go in and get that 2.74? Man, that sure would be nice, wouldn't it? Well, it's actually doable, believe it or not. You can see in this article, which I will link in the video description as well, so you can read it for yourself. There is a couple things to understand about the assumable mortgages. So it can increase the cost of borrowing slightly, but that interest rate is locked in and will be very beneficial in the future. So one thing you can do on here, there's a calculator to calculate your monthly payments. So let's go back to what we had done as the example when we were looking at interest rates. And we'll say instead of the 20%, we're going to do 5%. And we understand that putting 5% down is, of course, going to add PMI to the loan, but that's okay. We want to take a look at it anyway, 30 years. So let's say that we're looking at the current interest rate that we were viewing earlier, which was 7.093%. You can see here that an estimate of your monthly payment would be $2,395.07 a month. Again, this is just an estimate. This is something you would want to talk to your financial lender about, but we can go in now and let's say you assume that same mortgage and you do it at the 2.74% interest rate. So you can see your monthly payment goes down to $1,643.10. That is a huge difference. Assumable mortgages are a real thing. You can get them. If you would like information on how to go about finding out if that is possible on a home that you're interested in, reach out to us or your lender and we will help you figure that out. So you might be wondering what kind of loan is assumable. And this article actually covers that for you. So you can see FHA loans, VA loans, It is important to note in here that you do not need, as a buyer, to be a member of the military to qualify to assume it, although oftentimes they are assumed by military members. USDA loans are assumable, so that's important to note. And then, of course, just like everything else in life, there are pros and cons to assuming a mortgage. So, some of the advantages are when interest rates get very high, as they feel to be now, you can get that lower interest rate, which is great. It's perfect. But the downfall of that is you can only assume the mortgage that the buyer already has on the property. So let's say the home is being listed for, they give us an example in here of $250,000, and the seller's assumable mortgage only has a balance of $110,000. That would mean that the buyer would need to make up a payment of $140,000 to cover the difference. So that is a big amount of money, but if you're able to put that sort of money down from the sale of another property or some money that you have saved back, whatever the means may be that you decide is best for you with your lender and your financial advisor and your specific financial situation, if you're able to do that, you cannot beat being able to do an assumable mortgage. Oftentimes, though, buyers need to take out a second mortgage on the home if the borrower's amount does not equal out to that. And so that can cause some issues there. So, as you can see, this article says that the pros are that buyers may get lower rates than the current market rates. Buyers may not have to secure new lines of credit. Buyers do not have to take out large out of pocket costs when the equity is low. The cons of it, though, are that buyers may need substantial down payments when the equity is high. Lenders may not cooperate when a second mortgage is needed. And with two mortgages, the risk of default does increase. So, just worth noting on there, there's always two sides to every coin. So, again, discuss it with your lender and figure out what is best for your situation. You might remember back to when the interest rates first started rising significantly, when every realtor, real estate agent, mortgage broker, lender on social media was posting in your feeds, yeah, the rates are going up, but it's okay. You can date the rate and marry the house. I chose not to put that out there at the time because I felt like that was sort of a bait and switch for trying to draw in buyers at the time. Because realistically, I know that there are closing fees associated with having to refinance your home. You have to go through the process of appraisal and qualification and application, all that stuff again. Can be a real hassle for people who are busy just trying to live their lives. And I also was looking at what was happening in the markets and in the economy and thinking about whether or not the rates would really dip low enough where it would be beneficial for buyers to possibly refinance in the future. And the reality is, I just didn't see the interest rates going back down into the 2 or 3% anytime soon. There's a lot going on with the economy. I don't have to tell you what all of those factors are. There's plenty that we could mention on here. But in reality, we don't have a crystal ball. We can only go off of educated guesses. And that's what this is, an educated guess from me that the rates probably are not going to dip back below 6% even anytime soon. So that really might not be the best option right now on refinancing. Obviously, the rates are too high now. But even in a year, if the rates are down to, let's say, 5%, well, is that really worth the closing cost and the hassle it's going to take to refinance? I can't answer that for you, but you know who can? A qualified lender or a financial advisor that you work with and trust and who knows your specific situation. But it is a possibility to help you overcome the locked in effect. So I just wanted to throw that out there and mention that should the rates decrease significantly and you choose to refinance, that could be a great option for lowering the interest rate. And finally, the third way I think is a good idea to discuss in overcoming the locked in effect is the equity you've built up in your current home. So, if you're a homeowner who is considering selling and that locked in effect is really holding you back, and finally, the third way I think is a good idea to discuss in overcoming the locked in effect is the equity you've built up in your current home. It's important to take a look at the equity in your home. The appreciation on houses has increased dramatically over the last couple of years. So, the best way to figure out what kind of equity you have in your home is, of course, to reach out to a local real estate agent. If you're in central Indiana, we would love for you to give Barton Realty a call for us to do this for you. We can do what's called a market equity report on your home. And that's where we can tell you a price range of what your home might go for on the current housing market, wherever you're located, on a hyper local scale. So we can give you a pretty accurate representation of what your home could sell for in the condition it's currently in. And then we can figure out, once we've paid off your mortgage and your commissions and your taxes and all of the stuff that's involved with the real estate transaction, what that equity amount is that you're left over with, your seller's net proceeds. So, taking that number, sometimes it's much higher than what sellers anticipated because they haven't been in the market in a long time and they really just don't know what homes are worth. But you can take that equity and do an even larger down payment or do a points buy down on your next mortgage to help alleviate that high interest rate. So there are lots of possibilities out there to overcome the locked in effect. It's just a matter of finding the right one for you. If you're in a situation where you really just feel like you need to move, your house has become too small, you need a yard for your new fur baby, you're adding life to your family, and you really need an extra bedroom. Whatever the case is, we want to help you to get there. And sometimes that means really diving deep into what the current market is and what your situation is and figuring out what's best for you. That's why it's important to have a consultation from the beginning when you're thinking about buying or selling. That way, we can make sure that everyone's on the same page and we're all doing everything we can to ensure that you're getting the highest amount for your home and receiving the best deal you can on purchasing the next home. That's Thanks for spending some time with me today. Hope you have a great rest of your day. And remember, for all of your real estate needs, Barton Realty is the key.